Okay, let me introduce this panel. So it's actually a very good segue from Peter because we're now, this afternoon we'll be hearing from someone from Enterprise Ireland. We'll be hearing from the Halo network of angel investors. And you have had some questions about venture debt and international investors. All of those specific topics will be dealt with as we go through the day. But now we're going to talk about a later stage of raising capital, and that of course is the IPO stage, the listing stage. And who better could you have to chair this entire panel than Niall Jones, who's Head of Listing Ireland and UK for Euronext. Euronext, in case you don't know, if you've been under a rock, acquired the ISEC, the Irish Stock Exchange, some years ago. They have 7 stock exchanges. They're responsible for more than 2,000 listed companies and their funding requirements through the stock exchanges. And with him are people who have walked the walk in relation to this, people who've been through the IPO process. So without further ado, I'm going to give you this, which is the iPad. Do please get your questions in, Slido, and it's hashtag Raising Capital Summit, Raising Capital 22. Over to you now.
Thank you very much, Ivan. Can everybody hear me okay? That's perfect. Delighted to introduce the panel. We have Joyce on my far right, we've John Flynn, and we've Eimear Moloney. Jim is the CEO and co-founder of HealthBeacon. HealthBeacon listed in December last year in Dublin on the Euronext growth market. Jim was the CEO and founder of Point of Care Health Services previous to that, which he sold to Uniphar in 2013. So he's experienced on both sides of the track. Prior to that, Jim worked with Sharing Plough on the pharmaceutical side, and I believe before that in the financial services industry as well. So Jim's coming with a real wealth of knowledge over there on the far right. Next up, we have John. John is a corporate finance director at Goodbody, so he works with Don and Sarah from the previous panel. John has 16 years experience working with many of the leading companies in Ireland and the UK, helping them maximise their value through IPOs, M&A and capital restructurings. His experience is both at Goodbody and Credit Suisse before that, working with public and private companies, and he's worked on a lot of names that we're very familiar with, the Apple Greens, Cairn Homes, EasyJets, Flutters, etc. So a wealth of experience there as well. Eimear, last but not least, Eimear is a non-executive director who brings a wealth of experience in risk management, business development, and business strategy and finance to the companies she works with. She's currently a director on the boards of Irish Continental Group, of Kingspan and Hostelworld, and the privately owned Chanelle Pharma. Eimear made the transition over 5 years ago to this non-executive role, but previously spent 20 years at Zurich Life as an investment manager. So we're covering a couple of fronts here. But maybe what I might do is I might start with John. And John, just obviously we're going to talk a little bit about public markets here, but how do the companies in the room know if public markets are for them?
Sure. Thanks, Niall. Hopefully everybody can hear me. So I think the common feature among companies looking to go public is typically that they're looking to raise growth capital, whether it's for M&A or organic growth. And as many of the panelists this morning have alluded to, there's no shortage of options. It can depend on where the company's at in its life cycle, but it could be debt, it could be a strategic investor, or it could be equity, public markets. It could be private equity. But I think what differentiates the public market, the capital you get on the public markets, is that it's permanent in nature. So the investors who buy into your business at IPO are typically not there to make a quick buck. They're in it for the long term. The capital is what I call evergreen, so it doesn't have a 3 to 5 year horizon typically. That's not to say those investors will stay around forever, but that sort of long term capital can be very helpful in enabling businesses to plan for the future on a sort of a medium to long term view. I think the second characteristic that would sort of resonate with those on public markets is that it enables, if you're a sort of a founder manager of your business and you're keen to retain strategic autonomy and control of, where you take the business and how you run it. Public markets very much enable you to do that in a way that arguably, other sources of capital may not. So private equity will typically look to bring strategic value and typically look for a lot of, board involvement, and that can be extremely beneficial, but it can also be somewhat intrusive at times on a business as it seeks to execute its strategy. I think if you're a company in the growth phase that's sort of looking to boost your profile, whether for the purposes of winning new business or recruiting or retaining key people, I think that, IPOs can really help in that regard. But maybe lastly, just and some of the panelists earlier have alluded to this as well. Public markets aren't necessarily the holy grail. You don't want to go out too early. You want to sort of have an established equity story, be able to deliver against market expectations, and that generally requires you to be, reasonably well established. But by and large, I think growth capital and strategic autonomy are the two main characteristics that we see as common to IPO candidates.
And just coming to you, Eimear, from your experience, what is it about public markets that you like? You've been on both sides, on the investor and now on the board side. What is it that you like, that draws you about public markets?
Yeah, sure, Niall. I suppose the difference between being an investor and sitting on a board are two different positions, but they're both very much looking at public markets. I mean, what's really is interesting about public markets is they're very dynamic. There's a lot of different information being thrown at them every day, be it macroeconomic data, be it geopolitical risk, be it corporate reporting, results, etc. And I suppose when you look at it, I was an investor for over 23 years. I've seen a lot of different cycles, from the tech bust when I started my career, down to the GFC, to the huge liquidity that has been provided since then, how that has driven capital markets. So it's very interesting. I mean, there's a lot of noise on a daily basis, but it's great to see companies coming to the market, I suppose developing their strategy, creating value for shareholders, because I think ultimately that's what investors expect when they make an investment, is that strategy and that ability to develop and create that value over the long term. And look, investors have different time horizons. You'll have investors who are there for the short term, medium term, and very, very long term investors. So I think once you know your investor base, I think for companies it's a great way of being able to access capital.
And putting your board of directors hat on, is there a big step up between being a private company and a public company, or do some companies underestimate or overestimate maybe that step up that's required, given most of the companies are probably growth companies or would look to maybe join the junior market in the first instance? How big a step do you see that?
Yeah, I think something that Sarah in the last panel alluded to, that I think it really is about being prepared, the preparedness of where you are when you want to go to the market, to know the right point for the company to go to the market. There is a big step up in terms of the corporate governance piece, the ESG reporting that's required, the financial reporting that's required, the disclosures, all those investor interactions. They are all, I suppose, a meaningful step up for a lot of companies from where they've been. But I don't think if you plan it ahead well, if you work well with your advisors before going public, I think it makes that transition a lot smoother. I think, look, when you speak to companies that have IPO'd, they always will say, I think the biggest thing that they underestimate is just that amount of time and the distraction it can take if you're not prepared. It can pull you away from the day-to-day operations of the company. I mean, you can't allow that to happen while you're going through a process, because ultimately something goes wrong. So I think that preparedness is really key.
But even, I suppose, from the sustainability and ESG side of things, larger, smaller, larger private companies are still having to fall into the more in this realm as well. So I suppose maybe there are differences, but it's getting tighter everywhere, isn't it?
Yeah, I mean, they're not insurmountable. I mean,
yeah.
The gaps are narrowing between being a private and public company now because of the requirements from every investor, be it private, public, debt, etc. So I think it is becoming more of a level playing field there.
And Jim, as I alluded to earlier, you've done both. You've sold a company to a larger entity that ultimately listed itself over time. But what made you want to bring HealthBeacon public?
Yeah, sure. And I apologize. I just came off of a red-eye flight.
You
so
did.
I was wondering if my voice, arrived, at the same time that I've arrived. So
You're here.
Good morning to everybody. So for those that don't know HealthBeacon, we listed as Niall talked about in 21. My own background, or to answer your question as to why we wanted to look at it, I thought HealthBeacon as a company. Just first of all, who knows the HealthBeacon story here? A little bit. See how well we're doing in terms of penetration of the.
I think give a little quick refresher, I think, would help.
Yeah, right. So HealthBeacon, we build smart tools for managing medications. We're focusing on an area of the market that's really critical to the health of people that have a lot of chronic and critical diseases. So a lot of you might know people that might be diabetic or rheumatoid arthritis sufferers or chronic disease sufferers. We have a piece of technology that helps ensure that the medications that treat those conditions are better managed in the home setting. So we have kind of a world-leading stack of technology to really help those patients in the home setting. So it's a big. We have we describe it as smart tools for managing medications, but we have a really global ambition for the organization to be the leading medication adherence company on a global level, not just on a European or an Irish level. So we have a big ambition for the company, and we've harbored that ambition for a long time. Sometimes we have to be a little careful about looking at that. I think to John's point, a lot of times when you take early stage private capital, they do have a horizon on that capital. So if they might have a 3 to 5 year horizon, depending on their fund, where they're looking for a return back through that window. And sometimes building an iconic global, multi-billion-dollar company might take a little more than 3 to 5 years. Certainly that's my experience. If someone knows how to build it faster than that, I'm available to take advice. I think probably like a lot of us, ultimately as an entrepreneur, I built my last company, Point of Care, and we had a successful exit to Unifar. I actually found that experience excellent. We really loved working with the people from that organization. We thought they could take the company that last mile and allow that service to be accessible. It was a service that's focused on helping patients get access to medications. This business is a technology. It's unique. It's IP. It has a reoccurring revenue model associated with it. It wants to go into lots of different markets. I thought it might have the elements and the makeup, and then fundamentally we also build a physical product. So we have an underlying capital need that needs long-term capital, to be able to go into it. So we thought between the capital need of the product, the global ambition, and over time we have a reoccurring revenue model. So every patient that comes on our technology, we charge $30 per patient per month that comes on our technology. We're today at 10,000 devices deployed. We've got an ambition to get to 100,000 devices over the next 18 months. So that we thought that story might be accessible, to investors, and looking at it, that they could see, hey, I'm aware of this underlying need to support these types of patients. I can access that kind of revenue model. So we thought the story could be accessible to investors. I think, frankly, if you're like myself and you're really enjoying it, you'd love to see your company stay and keep growing, even beyond yourself. I think the public markets, could represent that opportunity, that the company could have its own, exposure that even goes beyond, what we're capable in the market. So there's lots of reasons, but
the IPO process itself as you had expected?
So
many twists and turns. I mean, obviously you did IPO already, and you had a sense of what you were letting yourself into for.
Yeah, I thought the IPO program that you guys run is excellent. So there was tons of exposure, and probably there's lots of people in the room that might participate in that program in terms of giving advice. So there's lots of good access to it. I think I describe it as it's like having children. Until you have children, someone could tell you what the process is like, to raise a child, but it's kind of, you have to go through it to understand it a little bit. But I thought, the advice that we got largely was, your point, Eimear, was, the preparation. You need a good CFO. I think we have Lawrence Flavin in the room, that had experience taking a company public. We had good advisors from Goodbody that were really acted as a team members for us and kind of preparing us. We felt prepared. I think the sheer amount of work, to your point of like the number of times that you have to go present the company, the discipline associated with that, a little bit different than the private market. So I think that was, I've raised a lot of capital for my company over time, so I was aware of some of those things, but it felt that that's probably the uniqueness of it was, when you talk to this institutional capital, or people leaning towards that institutional capital level, that presentation process felt a little bit different than, with venture investors. Someone was mentioned, I think Sarah was mentioning before. They talked about it like a marriage or something, where it's a very intimate. You kind of get to know these people over time, and they're going to be with you, in a way. Whereas the institutional investors, I think, look at it a little differently. But I don't know if that answers.
No, that's perfect. And maybe just on the actual IPO process itself, I might come to John. Can you maybe, just for the room here, maybe outline some of the kind of the key markers and the timings around an IPO process itself, a typical process?
Sure. So I suppose the first thing to say is there's no hard and fast rule about how long it takes to IPO a company. But broadly speaking, it sort of boils down to 3 key stages. The first one, which is probably the most important one, relates to early engagement with investors. So we'll call it the pre-marketing phase. So that can happen sort of months in advance, 5, 6, 9 months in advance of IPO. And it involves, as Jim has alluded to, discussions, presenting your equity story to investors, using that feedback to A, determine whether or not an IPO is a runner, and B, potentially to shape the equity story or refine it, or whether it's determining what the target returns should be for this business. So that can be hugely valuable to issue companies thinking of IPOing, because it enables them to make an informed decision as to whether or not to go down the IPO road, and they can do that before starting to incur any material level of cost in terms of bringing on board advisors, particularly on the legal side and the accounting side, which is, I guess, leads into phase 2 or stage 2 of an IPO process, which is what I'd call the sort of diligence and documentation phase. So at that point, very important to have your advisors on board. That's when lawyers pick up the pens on documentation. That's when the accountants start producing historical financial information and reporting on it. Engagement with investors proceeds in parallel with that, and your broker or financial advisor will work with the company through that process to sort of craft the message. But all the while during phase 2, you're effectively doing what's called shadow book building. So trying to get a better sense as to the level of appetite in the market for your business, and indeed what sort of valuation expectations or what valuation metrics the market is likely to put on that. That's the end of phase 2, which by that stage, you hopefully have enough, you and your advisors have enough conviction to potentially go public and announce an intention to float, which then leads to phase 3, which I'll call execution, and that's your formal roadshow. So by that stage, you're really humming. Your sales pitch is gets a gold star at that point, and you're ready for really serious dialogue with investors and beginning the process of formal book building and price discovery. So, as I said at the outset, no hard and fast rule as to how long it can take. We've seen it done in 3 to 4 months. Equally, we've seen it take 8 to 9 months. But I think the key point from a risk mitigation perspective, if I'm in the company's shoes, the benefit of having that pre-marketing phase to inform whether or not to go ahead is invaluable. And some, we've worked with companies where it has proven not to be optimal to go public, and they've chosen to go down the private equity route. Equally, it's worked very well with some of the companies we've taken to market.
And actually, Eimear, I suppose we, at the tail end of the IPO Ready course, we do some of these mock investor one-on-ones, a little bit like the early look for an IPO. So how did you feel that the class last year performed, and would that give you optimism, I suppose, that we're going to see more companies come through over the next few years, or how would you view things?
Yeah, Niall, as you know, I've been involved in the IPO Ready pitch day or pre-marketing, what would be equivalent if you were actually going to go IPO for the last number of years. So I've seen a huge variety of companies. I think, look, you see companies definitely at different stages of the life cycle as they go through. Some companies are there to see, are public markets for them? How IPO ready are they? What do they need to do? What stage they are in the journey? What do they need to do to actually get there? I think it's a big learning curve for some companies. Some companies are a lot more progressed in terms of very clear in their strategy, and that this is the route that they're opting for. I suppose I've seen some really exciting companies over the last number of years that hopefully, some of them are more earlier stages, others like Jim have actually come to the market, which is great to see. And I would be optimistic that we can continue to see that deal flow and companies coming to use public markets. I think we're probably a little bit of a crossroads, that there's probably a little bit more of a level playing field in terms of interest rates are starting to normalise. A lot of the liquidity that we saw post the GFCs coming out of the market now. So I think people may look at other options other than maybe going down what seemed like very cheap funding over the last number of years, to look back to capital markets and public markets and look to IPO. I mean, I think, look, Ireland has been a great success story. If I think of even through my career, I've seen a lot of Irish companies, Ryanair and Flutter, which I suppose came post the tech bust. In 2000, valuations would have been very low for those companies. Now the second largest gaming and leisure company in the world globally. Like we've seen Delata, Apple Green. I've seen companies come and go.
Yeah.
But I think I'd be optimistic about the future.
And Jim, I suppose we sometimes talk about, or people will hear of IPO windows. In hindsight, we had very choppy markets last year, but you IPO'd in December last year. You raised your 25 million of fresh capital. How do you view things now? Half full, half empty? I mean, in hindsight, how do you view things?
Yeah, I mean, you know, we're full. We raised the money.
Yeah.
We raised the capital. You know, you know, when I look at, you know, I just came back from the States, and I was looking at other companies that say that went public, talking to other contemporaries and colleagues that took their company public, you know, during maybe a similar time that we did. You know, so you know, I think what's critical for me is that I have the capital to build the business that I want to build, and that's, you know, that's kind of it. And then the theory is if we can get this business to the size and scale, we're interesting because we're still in some ways, you know, while we work with the largest pharmaceutical companies in the world, Sanofi's and Novartis and Teva, and then on the U.S. We work with Cigna, you know, insurance, and we're starting to work with Medicare in the U.S. So we're an interesting company that we have some of the biggest clients in the world, but we're really at a development stage in terms of them really scaling us. So that's the equation for HealthBeacon, and so there it's a you know, it's a 24 or 36 month scaling opportunity for people looking at us. We have the capital now to be able to build the infrastructure to get us to this, you know, 100,000s of devices and units into patients' homes, and that's so I think completely full from that perspective. I think the you know, when you see the, you know, the fact that your company gets marked to market every day, you know, I would definitely like to see more liquidity, you know, in those markets. And I think in some ways we're a little bit, you know, since not that many companies at our stage have gone public. I think I might be the only one of this stage in a little while, or last year. You know, we'd love to see other companies go public, so there's maybe even a little bit more, you know, domestic or, you know, people interested in the Irish market looking at stocks like this, so that you know, we feel like our company gets kind of priced to market a little bit, you know, more fair value on it. But you know, we feel really good about it. The profile, the access to capital, you know, and you know, we now have the, you know, the kind of the infrastructure. And I think all the, you know, I heard the other panels talk about is, you know, we really had to mature the company very, very fast around, you know, how we do reporting, you know, how we think about some of these other subject areas of, you know, sustainability and governance. And I think that's going to stand to us, because as people think about investing in us, you know, the fact that we are a public company, you know, they can have a certain amount of confidence in our infrastructure. We've been able to kind of get us maybe to that next tier of development company versus, you know, something maybe that's privately held and you're not sure how those processes are going. So, yeah, it looks super optimistic, I guess, is the summary.
And can we maybe end on a final note, John? Are we optimistic about the level of IPOs for next year? Or am I putting words in your mouth? Can't get any worse than this year, can it?
No, well, this is the thing, you know, IPO markets are very, very cyclical, but the same is true of right across the capital stack. So this year, yes, it's been challenging for equity markets, challenging for debt markets. Volumes from an IPO perspective globally are probably down 50%. But that's off a very tough comp last year. So last year you saw a huge amount, Don alluded to it earlier on, a huge amount of capital raised and deployed. And in the public markets, you saw a lot of SPACs, so special purpose acquisition companies. But if you compare this year versus a more long-term average, the decline isn't anything like as dramatic. Clearly geopolitical developments this year haven't been helpful. Inflation has gone through the roof. Volatility has been quite elevated. But even in the last kind of couple of weeks, particularly in the States, you're starting to see signs of stability emerging. And that generally is a sort of a portent of stronger levels of corporate activity coming through. So with that, you're starting to see confidential filings into the SEC in the States starting to emerge. There's increasing talk about companies in Europe looking to public markets. We're starting to see it in our business. Discussions are starting with prospects in that regard. So I would echo Jim's comments. I think I would be optimistic. It does feel like we're at an inflection point from a macro perspective, particularly in the States, and where the States goes, the rest of the world tends to follow.
Brilliant. I think we may as well end there because I'm conscious we're over time and Ivan might kill me. But I'd like to thank the panel, unless Ivan would like to thank the panel for me.
I just want to say that if our next panel will actually be founders, entrepreneurs, and so on. Just tell us a little word about your mentoring program for 10 candidates a year, because there might be, you have a stand here in Euronext. Just tell us a word.
Brilliant. Well, briefly, so we run IPO Ready. It's going to be our 5th version of IPO Ready. We'll kick off in January next year. We're closing applications this Friday. If there are any companies in the room, we probably have 1 or 2 spots that we can accommodate. We have a bit of flexibility there. We're looking to target 10 to 12 companies a year to do the course that Jim did, and that Jim's CFO, Lawrence, did with Finance Ireland prior to that as well. So we would love to chat to you later about it, but we have dedicated mentors. We do meet real-world investors. We meet the whole ecosystem, and we discuss all of the sources of financing in greater depth with a focus on IPO.
Niall, the program. So definitely, if you're thinking about it, I really felt like it was a pivotal program in a real kind of. If you're at that stage, even if you're not sure if you're going to go public, it's really worthwhile. The camaraderie, the colleagues, the access to the whole capital market system was excellent.
It's a nice network of founders who can bounce off each other. And I know in Jim's class, I think there were about 14 companies, but there was a good camaraderie there, and hopefully we'll see more of those companies.
If you want to be as rich as Jim Joyce,
do the course.
do look at the IPO Ready course. My thanks to Niall for chairing it. To Eimear, John and Jim, a really insightful discussion. Thank you indeed.
Thanks.
So we're going to resume. Please look at all the exhibitors and sponsors. You see the list here, including Euronext, Goodbody, and Martins and Mayer, all of the others. Please do that. We will resume at around 11 o'clock with a panel of founders. See you then.